Thank you for spending your afternoon with us. We really appreciate it. In investing, there aren't a lot of borders, and I'm constantly looking for different markets to, opportunities to invest in. I started investing in Kitchener-Waterloo actually probably about 10 years ago when student housing was a really big issue near the universities, and it was pretty much all ghetto, dilapidated student housing, and there was a real opportunity for a new type of housing. And there were some developers that were going into the area, and they were building condo buildings, and I bought, between me and my partners, about 20 units there, maybe 10 or 12 years ago, and we did incredibly well. So Kitchener has always been a market that I've known about. It's always been on my radar, and I was really excited when Condo Culture reached out to me and said, we've got this amazing project, which I had heard a bit about, but being mostly in Toronto, I didn't know everything about it. And when Tim came and gave me and my team the entire pitch, and we read through all the materials and we got to know what's happening in this incredible area, we got really excited. And I'm just super excited to be able to share this with all of our clients. And we think this is an incredible investment. We think this is the best investment that's in the market today. We think the market's changing, which we'll get into. So it's a really exciting time. I'm Ryan Coyle. I'm the broker owner of Connect.ca Realty. I'm also a real estate investor with over 40 doors, worth over $37 million, which we'll get into. I'm happy to share that with everyone and show you guys my portfolio and kind of my journey along the way. And today we're going to talk about how to build serious wealth through real estate. And a little bit more about me. I'm pretty involved with real estate. I've got a media company that focuses on educating real estate investors. I've got One Day Money, which is a equity-based lender. Marketable Property Management is a management company that manages over 400 of our clients' units, so we make investing in real estate easier, and then a few of our other media brands. So I've got Tim Bolton over here, who's been nice enough to host us all here today. Thank you, Tim. Tim is the VP of New Development Condo Culture. So I'm going to talk about investing and my journey and why I think that my type of investing is an easy way for people to scale and grow portfolios. And then Tim's going to jump into really this project and all the things that make it great. I mean, the fact that we're standing across the road from Google, which has a new sign, because that sign wasn't on there last week when I was here. 1,600 existing Google employees, 3,000 coming into this building that just opened. All six-figure jobs, and I think another 3,000 more in the next building, roughly. So that's obviously a buzz thing, but when you actually get to know the neighborhood, which Tim will go over, there's just so much more to it. All right, so the agenda, I'm going to talk about the iOS. The iOS is really the foundation, the pillars of what has helped me grow a successful real estate portfolio. And it's also the way of simplifying real estate investing, because it doesn't have to be that complicated. And those real four pillars to really make a successful real estate portfolio are the power of leverage, compound interest, earning money while you sleep, passive income, and time value of money. And then we'll look at how to turn one property in 40. And this is literally what I have done to turn my first property that my mom bought me and my sister by refinancing and scaling and growing over 21, 22 years, and turned it in over 40 doors today. We call that the multiplier effect, and that's what we help our clients do. We help them with the goal of buying one and turning that into 5 so they can retire wealthy and pass it on to their children. And then we'll look at the formula for that, which is refi, buy, rent, repeat. And we'll look at a look inside my portfolio, which I'm always happy to share. And then Tim will take it away for us and walk us through this amazing project. Let's start with the iOS. And what is it? Let's break it down. It's really an easy step-by-step system for creating serious wealth through real estate. And the pillars are the power of leverage. I love quotes, you see them everywhere. This quote's from Robert Kiyosaki. He was the founder and creator, author of Rich Dad, Poor Dad. Very successful real estate investor. And he said, leverage is the reason some people become rich and others do not become rich. Pretty blunt to the point. And what is that? It's other people's money. You've probably heard the term OPM in real estate investing. So other people's money is essentially taking the bank's money to go buy a very good, strong asset, and then you're getting a tenant to go pay the bank back. So you're actually using two people's money to create wealth and build wealth for yourself. And real estate allows for the most leverage, often up to 80% loan to value. And it's the cheapest leverage. So, there are other investments in the stock market where you can get maybe a what's it called, margin account. If you're fortunate enough, most people can't get a margin account, you have to qualify. But you could actually have your margin called at any day. If the stocks start going in the wrong direction, your margin call could be called tomorrow. With a mortgage, you can get a 30-year amortization on a 5-year or 10-year term. So banks are very confident in lending against real estate, and that alone is a very, very telling thing. The miracle of compound interest. So compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Albert Einstein, don't know if he's a real estate investor, but very smart guy. And when you understand compounding, whether it's in health or wealth, it's always a very positive thing over a long period of time. Often referred to as the snowball effect, where it's earning interest on interest and then on interest. And it's very powerful over a long period of time when you combine compounding, time, and leverage. An example here, $100,000 investment made in the TSX in 2003 would be worth 20 years later, $275,000 or 176% ROI. Not bad. When you take that same 100,000, put it down on as a 20% deposit, so it's about a $500,000 home 20 years ago, right? You're leveraged, you're only putting down 20%. In GTA, that home today, or last year, would be worth $2.163 million. Right, so that's a very, very good growth rate. But not only that, it's leverage, and it's the compounding, and it's the time of the investment. And then there's generating passive income, because I hear sometimes investors saying, I want to grow enough wealth through real estate so I can become a full-time investor. And for me, it's never been about that. It's always been about how can I use real estate as a tool to be able to retire or be able to enjoy more time with my family. So I think it's really important, and when I'm talking about these principles, they're really why they're the cornerstones of my portfolio and why I've done this. And passive investing is extremely important for me. I mean, I haven't even seen all my properties. I don't hear about them. I get a monthly report, and I get to see my cash flow, and I get to do an analysis of what they're worth. Very easy. And then there's the time value of money, which is a very important part of this. And by considering or taking this part of the equation into consideration, you're essentially, I don't want to say eliminating, but you're really reducing your risk, right? So, real estate has historically performed incredibly well over long periods of time. Over the last 2 years, real estate has not performed all that well. But when you look at the last 3 or 4 years that have been very, very tough for real estate investors, and you blend that into the last 10 years, you actually have a very strong average, which in Toronto, the condo market averaged about 6% over the last 10 years, including 4 years of terrible returns. And we're turning a corner right now, and I'm going to get into that briefly. So I think right now is a very good time to do that, because we're coming out of a bad market, and we're arguably going into a very good market. But real estate over a long period of time has performed incredibly well. In this example, this is the Toronto Real Estate Board, 6.43% annual growth over the last 45 years. Many down markets. You can't really see it in this bar chart. I kind of like line charts for that because you see more of the ups and downs, but there's a lot of ups and downs between that. And there's been 1 year periods, 2 year, 3 year periods where there's been terrible growth. But anyone who worked through that period of time and held on to it for a long time has done incredibly well. Another thing I want to point out, that's 6.43% annual growth. That is the growth of the asset, the end value. If you bought a $500,000 condo, it's gone up 6.34%. But if you put down 20%, 1/5 of that, you can actually times that by 5, and you've just realized a roughly 30% return on investment. It's incredible. And this highlights the growth that we've seen in Kitchener-Waterloo for the last 10 years. Extraordinary growth in the condo market. This is incredible, and similar to Toronto, why the condo market took off there, is houses became unaffordable. So a lot of demand moved to high rise, and that's why we saw so much growth in Kitchener, and why we'll continue to see more growth in Kitchener.
Ryan, just one thing. I don't know if the people that are seated can see what we're showing at the bottom there. The
Kitchener right. Sorry, yes. Right, okay, so Kitchener looks really good. It's at the bottom, it's the biggest one. It's gone up 152% over the last 10 years, 15% growth. Now, the last 2 years in Kitchener has been flat. I think it's actually been down. I'm very confident, that was due to an interest rate cycle, which we'll talk about, and which is also turning right now. So I think it's an optimal time to be getting back into this market. Now, this is the multiplier. So I want to walk you guys through a real life example so you can understand the power of this. And again, the multiplier is really a system that we've created for our clients. The multiplier is really a simplified system we've created for our clients to help them acquire 5 properties over a period of 10 years through using the equity of property 1 to be able to buy the further properties. So what is it? It's buy, rent, refi, repeat, and then you see the iOS build serious wealth. Equity in your property isn't working for you if it's sitting there. You need to make it work hard. So the main thing that I've been able to use over time for my portfolio is I've been able to use capital as cash flow, and I'm able to pull out capital to be able to buy more real estate. More Canadians are sitting on a mountain of cash in their primary homes, which can be used to build serious wealth. So what do I mean by that? A lot of people don't know this, surprisingly, that you can actually tap into the equity in your home through a line of credit, where you can get a line of credit put into place and pull out money when you want to, and then you pay interest when you pull out that money. So if you're, for example, pulling out money to go buy an investment property, you can do that through using the equity in your home or your investment properties. Now, refinancing, this is the important, I think, adding fuel to the fire, so to speak. Refinancing is the best tax avoidance strategy to ever exist, and it is tax deductible. So tax avoidance is not illegal. Tax evasion is, to be clear. You're avoiding paying taxes through a sophisticated strategy, which is actually not that sophisticated, but you're almost double dipping. So you're taking out money and you're going to use that as a tax deduction. If you refinance your property instead of sell it, you're not going to actualize a tax payment. You're going to defer that tax payment until you sell it, whether that's in 1 year, 10 years, 100 years. So you're not paying tax. And I'll show you an example of this. Not only that, when you take out that money, you're going to use the interest payment as a tax deduction, so it lowers your taxable income. And this is literally the formula I've used to grow my portfolio. So let me show you an example. This is a property that I purchased in 2017 in downtown Toronto. Had it appraised, purchased it for $602. Had it appraised at the peak of the market, probably about a year and a half ago at 1.175. This property is probably closer to $1 million now. This is in Toronto. That's how much it's fluctuated over the last 12 or so months. It doesn't bother me because I'm going to hold this for the next 20, 30 years. For this example, I had it appraised at 1.175. The current rent is $3,900 per month. The mortgage at that time was $482. The refinanced amount is 80% of the appraised value. Can you guys see this? I'll tell you, just take my word for it, okay? So the appraised value is 1.2. 80% was $940,000. And then I minused my mortgage, so I had to pay back my mortgage of $482. The point is, I was left with $457,000 that I did not pay tax on. I took that money and I went and bought 3 more properties, and I left $100K in an account to help pay the shortfall, the negative cash flow on the property I took that out of over the next 5 years. Now, this is an example. This isn't real numbers. It's just to give you an idea of what this looks like when you apply it over a period of time. So if you were to buy property 1 today that's worth $710,000, you would put down a $140,000 deposit, and in year 6, assuming a 7% annual appreciation, that was the long-term average for Toronto when I had made this chart. The long-term average now is 6.84%. So, we could use conservative numbers and this would still be a very impressive chart, but I was literally just using the long-term average at the time when I created this. And year 6, you could take property 1, refinance it, take out all of the equity, and buy property number 2, and then and then you would put an additional $160,000 into buy property number 3. So at that point in year 6, you would have a portfolio worth roughly $3 million. You guys can't see this, unfortunately, at the bottom, so I'm just going to tell you these numbers. But the magic over time with compounding and leverage, in year 12, you would refinance property 1, 2, and 3, and you would have enough equity in this assumption to be able to buy property number 4, 5, and 6 without putting any more money out of your own pocket. And what is really cool is that in year 12, your portfolio would have a value of $8.3 million, and you would only have $1.6 million in equity. But by year 25, and this is why we try to get our clients to build and build wealth over a long period of time, in year 25, your portfolio value is $20 million, and there's $15 million worth of equity. So that's 25 years of real historic numbers. If history were to repeat itself, that's exactly what it looks like. This is my portfolio today. Today it's got a value of $36.4 million. Last year had a value of over $38 million. So it's been fluctuating. Again, I believe we're turning, and we'll get into that, into a more positive market. But I wanted to show you guys this because really this has been built out of that first property that I purchased. And I was able to take the first property that my mom purchased. I sold that one because I didn't understand the value of refinancing, bought my next home, bought an investment property, and then I just started refinancing. And instead of paying taxes every time I bought a condo, this gave me the ability to be able to scale and keep more money in my pocket to be able to scale and build a portfolio. So, the reason why I want to show you this is the numbers down here show you the growth rate that you see over a long period of time once you factor in all of the leverage and all of the compounding. At this example, this is just a 4% growth rate. In 20 years, a $36 million portfolio would be worth roughly $80 million. And if we use the historical average of 6.43%, that same portfolio in 20 years would be worth $126 million. Now, before I hand this off to Tim, I just want to talk about what's happening in the current real estate market. The last few years have been extremely challenging. I don't think it's any secret for real estate investors. But what people need to realize is that the interest rate environment in Canada is cyclical. And we've been taking money out of the market by increasing rates, the government, for the last 2.5 or so years. And that has always historically had a negative pressure on pricing. But what's happening right now is rates are starting to go the other way. And the media is starting to see, first I'm on the front lines, I see it as a real estate agent every day. We're getting more and more showings on our listings. We're seeing properties appreciate. We're seeing multiple offers again. We haven't seen that in 2 years. So it's really, really exciting. But here you'll see, I just typed in real estate market update when I did this, I think yesterday. Positive news in Toronto, positive news in Vancouver. Sales are increasing in Montreal. TD it predicts a sizable bump in housing. So that's really important to kind of understand why that's all happening. And, markets go like this over time, and, there's a trough and a peak. And we're arguably in a trough for the last 2 years, meaning real estate prices have gone down, they've hit a bottom, and they have nowhere to go at this point other than up. So, you could speculate that that's going to happen here, but what really is telling is that Canada is always operating in a cyclical environment. If you look at these stats here, I don't know if you can see my pointer. Can you guys see my pointer? So this was the peak, right, in April 2022. And in April 2022, when we were at the peak, the Bank of Canada came and said, hey, wait a minute, we're going to start increasing interest rates. As soon as that first rate increase happened, prices started going in this direction. And this isn't any surprise. This is exactly the purpose of increasing rents, is to take money out of the economy, and housing being one of the leading numbers in GDP. That's one of the main things that will be impacted, right? So as we started to increase rates further, interest rates or prices continue to drop. But what's interesting here is rates held firm early 2023. And as rates held firm here at 4.25 or 4.5, we started seeing prices go up. The government said, wait a minute, we got to throw more water on this fire, because that's all it is, a bonfire that will continue to burn. And they're just throwing water on it through interest rates. So they increased rates again, and that sucked the life back out of the market. But now we're starting to see interest rates come down here. And there's an inverse correlation. As rates come down, historically prices have always come up. So that's why I think it's really important to realize that we're in that changing market. And a lot of people are reaching out to me almost daily, asking me, buyers, sellers, what should we do? How should we manage this market? And I try to simplify it for them. And I say, if you are a seller in this market, hold, don't sell. Everything is pointing to the market coming up right now, going up in value, appreciating. I look at it this way. On my properties, I think on average, they'll be up $50,000 to $100,000 within the next 12 months. That's the way I look at it for myself. And when buyers ask me what they should do, I say buy. There are opportunities in the market that are better than I've seen in the last 20 years. On the resale side, pre-con side, we've got a low deposit, incredible incentives. You don't see that in a good market. So, it's a really good time, and that's kind of my segue into you, Tim. Before I hand it off to you, I have this one final slide because I think it's really important for people to understand that their money needs to be working for you, and money sitting in your bank account or your home is dead money as far as I'm considered. So this deal, to put it in perspective, you can invest with only 10%. Typically, it's about a 20% deposit. So you're putting down 10%, in my opinion, sooner rather than later because you're getting 5% guaranteed interest on it. And then you're not putting down anything else for 4 years. So you've got a very long runway. And this gives you the opportunity to invest for as little as $52,000 down. Now, let's talk about leverage again. Typically, when you're factoring leverage, you have a mortgage and you have a mortgage payment. Here is the ultimate leverage because you're getting the capital appreciation on the full asset, the appreciation on the full asset, but you're not actually paying or taking out a mortgage. So you're going to get the appreciation on the full asset. So look, very conservatively, pessimistically speaking, which I am not, if it only went up 2% per year and you put down 10%, your return is actually 20%. So it's important to understand that because if you have money sitting in your bank account, you're losing money every single day with inflation. You're probably earning 1% in a savings account, and with inflation, your money is being deflated. Another really unique thing about this development, which I wanted to highlight, because if you have money sitting there, it's going to work hard for you here, is you're getting a guaranteed 5% interest on your deposit. So, if you have $50,000 sitting in the bank, you're going to be able to get a 5% interest on it, a guaranteed interest on it as well. So, I think that's really important when you're factoring, how your money is going to work for you. You need to look at all of those factors: leverage, compounding, and obviously the opportunities that you can take advantage in this market as it's turning. Tim, I'm going to hand it over to you. I think you have a lot more to talk about with the market, and then get into platform.
Yeah, so thanks everyone for coming. My name's Tim Bolton. I'm VP of New Development at Condo Culture. I'm going to invite Rob McPhee up. He's a sales manager here at Platform in Station Park. I'm going to pull up one of Ryan's graphs. I was quite interested as we were going through it there. So the one thing that really struck me with this graph is that it does go up and down. And for those that have invested extensively in real estate, you would recognize a pretty predictable buying cycle. So if you go all the way back to 1987, 98, 1988, you see that the graph is on an upward trajectory if you're close enough. At that point, the market's approaching highs. Everyone's buying. You're buying. Everyone that you know is buying, right? It's easy. It feels good. But then the market crests and it starts to come back down. It reaches a bottom. Near the bottom, no one's buying. Your friends and family are telling you don't want real estate. It's a crazy thing to do. You don't want to be into it. But then something crazy happens. You approach a couple years later and you're 95, 96. All of a sudden the market's going back up, right? And so it starts to feel good. By 2010, it's feeling really good. Everyone's doing it again, right? And it keeps going all the way up to 2015. You're at a peak there. Everyone's buying real estate. Market pulls back. 2016, 17. People aren't doing it again. It's less easy, right? It's not as easy if everybody's not doing the same thing as you. All of a sudden, COVID comes, people are fearful, people are out of the market, real estate's not moving. Interest rates go down, as you mentioned earlier, Ryan. The market goes crazy. Values go through the roof. If you're invested in real estate, you did extremely well during that period of time. It was very lucrative. We've got a local example here in Kitchener-Waterloo. 2022, before interest rates started going up 2 blocks from here, there was a tower called Tech Tower. It sold. Beautiful tower, 40 plus stories, 500 units, would you say? about 500 units. That tower, because the market was feeling so good, sold for $1,400 a square foot. So that's about a 40% premium to where it is today. People have valued Kitchener in a way where they look at it and they say, this is the future. We're willing to pay big dollars for this. And why were they doing that? Well, the market was at a high. It felt good. Can you pull up that market cycle graph? And I think the important thing to remember when you look at that graph is that behind those bars on a chart, there are actual people. People have feelings, and those feelings are what are going to drive your individual investment decisions, right? So we look at that, right? You go back to 2019, 2020, COVID-19. We're over here. Everyone's scared. Interest rates start to drop. Cash is injected into the economy. You get optimism, excitement. You get thrill and euphoria. The euphoria stage is when everyone's investing, right? It's like a phrase among real estate agents was, I have units in hand. It didn't matter what the units were. Units in hand, people were throwing money. So you'll buy. That's at the top of the market. Interest rates go up. It's not going to be that bad. Interest rates go up a little bit again. Now it's becoming more punitive, and you ride this roller coaster down to a point where some investors panic and sell. Some people will capitulate and actually exit the market. And at the very bottom, there's despondency. Despondency simply meaning, I'd never invest in real estate. You'd be crazy to do that. But then a funny thing happens. It's usually driven by the economy and the availability of capital. All of a sudden, rates start to go down and people start to come back into real estate. Not all at once. There's skepticism. For everybody that buys, they're going to have a cousin or a brother that says you're crazy for doing it today, right? That's skepticism. That's what happens. And that's important because it's when those people come into the market following the first movers that the real money is made. So you get the skepticism, the hope, the relief, optimism. You go all the way back over there to excitement, thrill, and euphoria. And that's how you make money in real estate. You go in before everyone else is doing it. And I think that's the opportunity today. We've already seen in Kitchener, people are willing to pay 40% more than you would need to do it today. And it's capitalizing, not being an emotional investor, but being a numbers-based investor. So if that kind of like jogs your interest in investing in real estate, it doesn't mean that it needs to be Kitchener. If you're investing in a stock, you're going to want to invest in a stock that's got growth. Like people love NVIDIA right now, if anyone's in that market, because of artificial intelligence, right? So what NVIDIA offers is the opportunity to invest in the future. That company is growing. You invest today, you get tomorrow's benefit. The same thing holds true in real estate. Kitchener is growing very rapidly, and even if you're from here, which I am, you might not know that. So we can show you a couple pieces of information, because what you want to be in is a city that's good, but you want to get there ahead of some of the growth. So if we look at where Kitchener is positioned relative to all of the major cities in Canada, Calgary, Montreal, Edmonton, these are not statistics that we've eliminated any cities from. This is all of the major cities, every metropolitan area in Canada. Fastest growth rate per Stats Canada is Kitchener-Waterloo. So we've got growth that's happening here. But it's not just pure growth that matters. You want to make sure you've got the right type of people coming in. So then we look at what is the age group. So if we look at condominiums, you've got 30-something units, Ryan. Would you say that they're mostly rented to younger folks or older folks?
Well, mostly rented to
younger, right? So the reason that matters is if you're going to buy a house, it's a pretty diverse tenant mix. If you're buying condos, you want to look at where do young people want to be. So Kitchener-Waterloo is growing faster than any city in Canada, but that growth is concentrated in a very narrow demographic. Over the last 5 years, people in their 20s have grown by 29%. So our population among that young crowd is growing faster than any other city in Canada, and they're moving into condos. For people in their 30s, again, we're at 20.2% here in the region, faster than any of the other cities in Canada. And that's not to say that Toronto's not growing well. It's growing in a fantastic way. But Kitchener is growing more quickly. So to bring it a little bit more micro, so citywide we've got a lot of growth, and growth is important, but an investor wants to know who that growth is. Are they people that have means? Are they going to buy your condominium investment from you for a great price? Are they going to pay a premium on rent? If you're interested in Airbnb, is there a market for that? Is there any reason to be in this specific location? So we've prepared this. This represents the site that we've got here, so this would be the platform. And what we wanted to show you is what Kitchener is all about. Maybe not on a citywide basis, but in this narrow area. And for those of you that can see the screen, some of it's hidden at the bottom. Within about 900 meters of this site, we've got some of the world's largest companies. So on the outlying areas, we've got Oracle, we've got Square, now named Block, we've got Toyota that's here. We've got major companies that are here. Of course, Ryan, you mentioned directly across the street is Google. But when you look at Google, you can't really appreciate the full story. So Google's got 180,000 square feet there. The 180,000 square feet are full. So that's fully staffed. Those people are there. They don't need housing, so they're not a reason to invest in this area. The reason to invest in this area is they've got a much larger building. Ryan referenced it. The sign just went up, and they don't have people working in there yet. So those people are coming. They just put the sign on. If you go onto the internet, and we always say you can Google jobs Kitchener, but if you do that, you'll see that they've got several hundred jobs hiring for that exact building at any given time. So why does that matter to an investor? Well, I can't think of another opportunity, and Ryan, maybe you've experienced it, you've got a lengthy career, but I can't think of an opportunity to invest directly across the street from one of the world's, if not the world's, most recognizable company right before they triple the size of their workforce. And that's really what Station Park and the platform offers here. Those people are coming. They have not impacted the rental prices yet. They have not impacted sale prices yet. So today's buyer gets in. That building will become filled. They build the building behind it, which is another Google site. And all of a sudden, in this immediate area, you've got thousands of people that are going to impact the real estate market that are not here yet. One more slide on Kitchener to underline the importance of supply and demand would be our vacancy rate. So no investor wants to buy in a city where everything sounds great, but there's a surplus of condominiums. If there's too much supply, what you're going to have is price competition. As an investor, that's going to drag your rate down. So we looked at the CMHC statistics for condominiums, Canadian Mortgage and Housing Corporation. So these are not our proprietary things. These are government-sourced pieces of information. Across all of Canada, there are other cities that can compete with Kitchener, but nobody has a lower vacancy rate in condominiums. So if you buy a condo here, you've got growth. The growth is probably going to be fueled by technology because that's who's coming in. That's fueled by the University of Waterloo. But you're going to have people that want your unit because we simply don't have enough of them. We don't have enough today, and every single year that moves on, we're actually increasing the size of the deficit. We're not building quickly enough. The region projects by the year 2031, I think it is, Rob, we're going to have almost 40,000 fewer housing units than we need. So that's going to have an upward pressure on supply and demand, and it's going to do some great things. So that's Kitchener. Kitchener's got a 10 percentage point concentration in tech. Our whole workforce, 10% is tech. They make big money, and I think that's an important thing. So it's a great city, but then if you believe in the city, you still have to believe in the project. And so, sir, we'll now hand it off to to Rob, and he's going to talk a little bit about the project specifically and Vanmar.
Thank you, Tim. And I hope everybody's doing okay. I know we've been through two speakers. I'm aware I'm the third speaker, so
you gotta be
I gotta
really
be on it. So yeah, to talk about the project, I mean, I think the point to underscore, and I think Ryan and Tim have already touched on this at length, but like we've got population growth, we've got 20-something and 30-something demographic, but the point is within 900 meters of Station Park, all of those salaries are six-figure salaries, and that's something that's very different than anywhere else you're going to see in southwestern Ontario. So what is Station Park? Why should we care about Station Park versus other condo projects in Kitchener-Waterloo? I think the easiest one, we've got 5 towers coming on this 6-acre site, and that's 2,300 residential units. So with that, you're able to get way, way more in terms of amenities, in terms of commercial units on the ground floor, and I'll cover what all that means. But if you're coming to this area for a 2-year software contract or to work in the next big tech startup, I mean, you're gonna want that Toronto stratified living lifestyle, right? And unless you've lived here, I mean, I think you guys are the only ones that are from the area, you might not be aware that we don't have that, right? Like we don't have that Toronto experience where you could wake up in a condo, go downstairs, grab an espresso, get some groceries, hit some retail, and all that before you're in your car. Kitchener currently, I mean, you can live in a condo, but you've got to drive everywhere to get your groceries and everything else, right? So Station Park is that first true live, work, play situation where not only are you right where you need to be, but you've got commercial, retail, restaurant, grocery on the ground floor. And I mean, obviously this is a bird's eye. You guys probably saw the first 2 towers that occupied last summer here for Tower 1, Tower 2, Tower 3, which is 98% sold, Tower 4, which is what we're talking about today, and then a 5th tower that's coming up in the future as well. And what you can see on the ground floor of all these towers is commercial, retail, restaurant, grocery. There's 25,000 square foot grocery space in the base of Tower 5, likely to be Whole Foods or Farm Boy. You've got a whole food alley area here. There's a major restaurant tenant in the base of Tower 4, likely to be Brown's Social. This walking piazza throughout most of the year converts into an ice rink in the wintertime, and that's to drive business traffic even in the dead of winter. You've got the Kaufman House, which will be revitalized as a high-end restaurant and social club with a brewery and distillery off the back. And this is all public-facing amenities. Like if you've got people that are coming in from the area, they'll want to shop at Whole Foods. We don't have a Whole Foods in Waterloo region. And if you're right down where all the tech business is, you're thinking about, or you're working at one of these tech businesses and thinking about where you want to live, you're going to want to be in these towers, right? And that's before we even get into the resident amenities that exist among the towers.
Yeah, one point on that, Rob, before you transition. So typically a developer will buy, I like to call it like it's like this rectangle of land, and you build a tower straight up from it. And whatever's around you is your community. If there's great stuff around you, then you benefit, and if there's not, you're powerless, right? So this is a 6-acre site. Rob's taking you through a number of what those amenities are. But this would be a master plan community. So in this case, the developer had so much land, they were able to think about what will make this a great living experience, what does the area need, and actually put it in. And I learned from Ryan, and I don't know what the numbers are, you can jump in if you want, but these types of master plan communities that offer, as Rob will show you, more community benefit, more convenience for an investor will outperform over time because they don't leave anything to chance. It doesn't matter, what goes up next to you, because within your community, you've got everything that you could possibly want, and that's what tenants pay for, and that's what buyers are going to jump in and pay more for.
Well said. One of the major resident amenities that you see, this already exists. I think you've been over to this space, Ryan. This is just the lounge that you get with Tower 1 and Tower 2. And obviously, they've got legit bowling lanes put in by Brunswick. This is just an area where you can co-work, hang out. They've got a great beer and wine fridge situation behind there. I think if there was one difference in this picture, I don't think they have the diamonds on the front of that bar. I think it's like a gray instead of those diamonds. But this is what you're getting as just like a regular amenity. Some of the stuff you don't see in this render, there's a 2-story gym with a glass wall that overlooks an aquatics room where you've got swim spas, an oversized hot tub. You've got a totally separate dedicated Peloton studio with 5 bikes. And this is just the kind of stuff you've got access to as a resident in the project.
And if I can jump in on that. So we saw this picture in 2018. It's now built. It's right over there. And so what Rob's saying basically is what you see, like you're going to see renderings for this building. You're going to see something called a sky deck. You're going to see a children's play structure. A lot of the times you see pretty pictures, and then you hope for the best. This developer, and Ryan, I think you've been over there as well. We saw this picture, oh yeah, bowling lanes are going to go in. I wonder how that's going to look. It looks like people actually think it looks better than these pictures when they go over there. And I think that's important because if you're putting down your money for something that's going to be available in 4 years, you want to be darn sure that you're going to get what you're being told that you're going to get. And so for us, it's easy to have these conversations and these presentations because we've seen this developer go through and show us the pictures and then build it the same or better. And so it's a confidence builder.
Yeah, well said. One of the details I was really blown away by is they actually have a room for bowling shoes, and the bowling shoes say SXP on the back. It's kind of a quirky detail, but it's very cool to see it realized. Some of the amenities in Tower 3 and Tower 4, there's a full-scale gaming room with full-size game consoles, recording studio, and music rehearsal space. And the reason why Vanmar is including these things, like similar to the ice rink actually, like Vanmar is throwing an ice rink in there because yes, it's a cool factor, but it also drives business traffic for all of the high-end businesses. If it's somebody like Whole Foods that's in a major grocery retail space, they need traffic throughout the entire year, right? So having an ice rink drives that. Having a recording studio in your condo project, and I can't think of another condo project I've heard of that has anything like that, but the reason they're including it is it hits that tech demographic square on the nose. Like we've all seen downtowns move from like Irish pubs to ping pong bars and stuff like that. And the reason why that's happening is you have to have a vibrant source of entertainment for people in their 20s and 30s. And Van Mar is very well aware of that. And it might not be just the arcade that pulls in the people from Google, but when you're looking at everything downtown Kitchener, and then you've got something that has arcades, outdoor hot tubs, indoor hot tubs, an infinity pool, a Whole Foods, like everything you could shake a stick at. I mean, they're coming here. Like that's what it comes down to. They've got a family center in Tower 4. One of the things we've seen everywhere, I mean, definitely in the GTA and more increasingly in the Waterloo region as well, families start in condos, right? It's very rare that you've got a family just, they're flush with cash and they're starting in a single family detached property. They start in condos, and having a space that's like a dedicated family center like this, I mean, it's something you've got all year round that you've got access to. One thing I like to touch on as well before we get into the Sky Deck, which Tim mentioned, is that Van Mar and Station Park thought to include Airbnb licenses, and it's something I won't get into too much depth on, but it's one of the only condos that would have access to something like this in the area. One of the things I like to joke about with Kitchener is that nobody comes to Kitchener on vacation, and that's very accurate. I mean, we don't have a body of water, but we have a lot of executive travel. So if you're coming here as an executive traveler for a couple of weeks or even a couple of months, typically you're staying at the Delta, which is about 10 minutes from here. And it's the typical stay. It's not a bad hotel, but compare that to an Airbnb unit where you've got a full dwelling unit, you've got a grocery store downstairs, you've got bowling lanes, you've got multiple swimming options, you got a full-scale family center. And I mean, you draw your own conclusions. It's just going to be a way better way to stay as an executive, right? So for investors, that just means you're collecting a hotel rate on a nightly basis. Downtown Kitchener has a 72% average occupied, which just means if you average the least busy months and the most busy months throughout the entire year, that's 21 days a month that are booked. So that's really incredible. And the fact that Van Mar's limited the licenses to a small number, I think their target utilization across 5 towers is 10%. So it's not going to be like crazy Airbnb, but for investors that are in the know, they can get that license and just get a nice cash flow positive on a monthly basis, right? So the amenities are all included in the condo fees. And again, it's the power of having 5 towers and over 2,000 units on the same site. You're paying a lower condo fee than what you're going to pay at a single tower, but you're getting 20 times the amenities, right? And I mean, it's just like, where else are you going to get over 2,000 units on the same site? With Airbnb, I will mention like there is an additional fee for that. Like if you've got a license, it's a $5,000 one-time fee that you pay for the license. If you're operating an Airbnb, I think it's an extra $50 a month. But if you're not using your license, you can park your license. You don't pay that extra. And that just covers the fact that they have a live concierge in Tower A. So when guests arrive, they literally talk to a concierge the way they would at a hotel. They validate with ID. They don't even get a physical key fob. They get a key on their phone. They just tap it to the locks. It's all keyless. So a lot has been really well thought out in that regard, and it's a huge opportunity for investors. Yeah, so interestingly, Station Park, the name of the entire project, the station in that is, they named it because there's a transit hub coming up right over there. At the time all 5 towers are done, roughly 2030, that'll exist. You'll have two-way GO service every 30 minutes. You'll have a train coming in from Union Station downtown Toronto. It'll still be a 50-minute trip. But you've got a train with Wi-Fi every 30 minutes coming in from Toronto. And that's like right beside Google. Yeah, with the Sky Deck, I think that's a major amenity for Tower 3 and Tower 4. And I mean, we covered the public space on the ground floor with the ice rink, the grocery store, the multiple restaurants. And that's, again, that space the public comes into, they use, the residents also benefit from that. This is a 4th floor private park that's off the back of Tower 3 and Tower 4, so it's this platform right here. And obviously every condo unit has a balcony, but you're not going to work out on your balcony. You're not going to do stuff you do in a backyard or a park on a balcony. So you've got this space for that. You've got everything from an Olympic-sized running track, outdoor hot tubs, a lot of wellness features, like there's a yoga deck, lots of trees. And I mean, Tim was sort of hinting at this earlier with the bowling lanes, but like we see lots of renders from developers, and one of the unique factors with Van Mar, they're just able to deliver that quality. So like the level of this environment that they're creating for people, they take that very seriously. One unique factor with them is they are a national builder. So they started in 1973 in Vancouver, and built a lot of high-rise and mid-rise in that area, and expanded over the years out to Ontario and elsewhere as well. Waterloo Region is the only area where they operate as both a developer and a builder. So that just means that they're hiring themselves to build the project. They have a lot more control than what you typically see. It's what's referred to as an integrated developer, where they have their own in-house team building. And like one example of that would just be that I think a lot of people have been through a PDI inspection. They hand you the green tape, you go through, you leave feeling a bit scarred because they got you to flag a bunch of stuff. With Vanmar, they do that inspection 3 times before you even see your unit. So they give you the green tape, but there's nothing to flag. And the reason they're doing that is they just know that that's an experience that every purchaser goes through. And if you can make it easier, why wouldn't you just make it the best experience possible? And it doesn't cost them anything extra to do that. It's the same company delivering it. Anything you would add to the Vanmar piece, Tim?
Yeah, I think the one thing that I would add to that is like if you're going to invest with a developer in a city, you want to know that that developer has a lot on the line. Like obviously they're staking their own money, but are they planning to be in that area for the long term? Because if you're a developer that comes into Kitchener-Waterloo, you do one building and you're going to get back out, it doesn't really matter how it goes, right? If it goes well, it's great. If it doesn't, I'm going to go do it in Calgary next. Vanmar is not like that. So on this map alone, there's 3 additional sites, I believe, that Vanmar owns. Their total pipeline in Waterloo Region would be greater than 5,000 units. And so what that means is that every time Vanmar hands the keys to, it could be you, that's going to create another tier on their reputation, right? Locally. For them to succeed, every time they hand over the keys, that has to go well, because they don't have the luxury of disappearing and doing it somewhere else. They're fully invested in this region. And so it's effectively a job interview for Vanmar, the developer here, every time they hand over keys. If this one goes well, you might tell some friends to buy in the next one. If that one goes well, they might tell their friends to buy in the next one. But if it doesn't, the whole thing stops. So I think there's some comfort to be had from that. This is a developer that's so confident in its abilities that they're saying we're going to concentrate in a market that we believe in. And I mean, I think that's significant too. They've looked at the growth in Kitchener and said this is the only place that we want to be. But they're also confident enough in themselves that they know that every time they hand over a building, people will be happy, and we've seen that. So I'll hand it back to you, Rob, but in Tower 1 and 2, those were done about a year and a half ago. People did their pre-delivery inspection. They got their units. They came over here and talked to this guy, and in some cases bought multiple units because they wanted to be real estate investors, but they didn't like the uncertainty. And getting their keys and seeing the quality removed that for them. So that was a powerful catalyst for sales in the last tower that we did. Just the fact that people, they didn't have to worry. They knew what they were going to get.
Well said. I mean, I don't have too much to add other than just Vanmar's, they say frequently that every project's a job interview, and sometimes people joke, happy customers tell two people, unhappy customers tell everyone, right? And I think that's one of the things where Vanmar, because they're building the project and developing the project, and they have so much skin in the game with the land that they own in Waterloo Region. I mean, they can't afford to do anything other than the absolute best in the area, and they're able to deliver that. So, any questions anyone has about Vanmar or Station Park?
I'm just going to add one thing. So, like, we're the marketing company, so we work for Vanmar Developments. They're the builder here. Our job is to figure out how and when we're going to sell developments. So this one will be launching in 2025. So when you'll see the billboards and the public, and hopefully, if we're doing our job well, the lineups will come in 2025. But what we've decided to do in advance, and this was a big priority of Vanmar's, was to work with groups that take the time to educate their investors, build relationships, and bring quality buyers to a project. And we got permission to do a limited number of those deals with groups prior to the launch in 2025. So Ryan, like, we respect the way that your team does business in terms of making sure people understand it. And so Ryan's team would be one of 10 in the province of Ontario that actually have the access to sell here at Platform and at Station Park. So there are some incentives, and I don't know if you want us to look at them or if you guys want to have them in your one-on-one conversations, but we've built a program specific to these groups that when we launch in 2025 won't be available anymore, because as those rates drop, the developer won't have to be as generous. But right now, to build that initial sales cycle, it's 10 groups. Other people are calling Rob every day. We tell them, sorry, it's not available. Some of the biggest groups in Toronto, not available. And that's because we like relationships and we like education and high quality buyers. So for that reason, exclusive opportunity, and it won't be as good. The incentives that we have today will be gone. Prices will be higher because that's just business. You do it when you can.
So I mean, the first one, we got a $20,000 discount. And this is something that only Ryan and a couple of other brokers in the entire province have access to. 2 years of free condo fees, which means no condo fees until 2030. A lot of investors, I mean, some people buy and hold for longer than a couple of years. A lot of investors will exit before they ever pay a condo fee. 5% interest on deposits. And the reason why Vanmar is including that, there are a lot of people that just think about, like, why wouldn't I just keep my money in a GIC or something like that, make 4.25%. I mean, here you'll make 5%. So it's just sort of like a double investment. And one of the interesting factors, like why Vanmar is offering this, Tower 3 and Tower 4 are actually part of the same financial project. We're essentially sold out in Tower 3, like this sold to 98%, and Vanmar held back the remaining units for trades. So most projects you'd be having to sell 70% of the units before the construction finance bank says, go ahead and build the project. Here we're halfway there. So by the time we open up in 2025, we're likely to already be at construction financing. So this just helps with groups that educate well, like Ryan's group, rewarding those groups for introducing their buyers. And you guys get a discount and some additional nice incentives that aren't going to exist in the new year. So I think that'd be the main thing. And you can see, like, there's a lot of value. We didn't really get into how much Vanmar's engineered Tower 4 to pack value into each unit. But even the smallest unit is a true 1+ den with the ability to have a closing door. We've got 3-bedroom units. There's a ton of value in what's being offered. It's a 10% deposit. So, I mean, you're able to get very far with not much paid in deposit.